What are mutual funds and how do they work? Mutual funds are a popular investment option that offer a convenient and cost-effective way for individual investors to participate in a professionally managed portfolio of stocks, bonds, and other securities. By pooling money from many investors, mutual funds provide a level of diversification that would be difficult to achieve on an individual basis. When you invest in a mutual fund, your money is combined with the money of other investors to purchase a diverse portfolio of securities. This portfolio is managed by a professional money manager who is responsible for making investment decisions and executing trades on behalf of the fund's investors. The manager's goal is to achieve the investment objective stated in the fund's prospectus, which can range from generating income to maximizing capital growth. One of the main advantages of investing in mutual funds is that they provide access to a professionally managed portfolio of securities at a relatively low cost. This can be especially beneficial for individual investors who lack the time, expertise, or resources to manage their own portfolios. Additionally, by pooling money from many investors, mutual funds provide a level of diversification that can help reduce overall investment risk. However, it's important to keep in mind that mutual funds come with different levels of risk and return potential depending on the types of securities they invest in. Before investing in a mutual fund, it's important to understand the fund's investment objective, its historical performance, and its expenses, as well as your own investment goals, risk tolerance, and time horizon. By taking these factors into consideration, you can make an informed decision about which mutual fund is right for you and how to use it to meet your financial goals. How to choose the right mutual fund for your investment goals. When choosing a mutual fund, it's important to take a systematic and informed approach to ensure that you select a fund that aligns with your investment objectives, risk tolerance, and time horizon. Here are some key steps to follow. Define your investment goals. Before investing in a mutual fund, it's important to clearly define your investment goals. Are you investing for retirement, a child's education, or some other specific financial goal? Knowing your investment goals will help you determine the types of funds that are best suited for your needs. Evaluate your risk tolerance. How much risk are you comfortable taking on in your investments? This is an important factor to consider when choosing a mutual fund, as different funds carry different levels of risk. Consider your time horizon. How long do you plan to hold on to your investments? This will help you determine the types of funds that are best suited for your time horizon. For example, if you have a long-term investment horizon, you may be able to tolerate more risk in your investments. Research mutual fund options. Once you have a clear understanding of your investment goals, risk tolerance, and time horizon, it's time to research mutual fund options. You can start by looking at mutual funds that are in line with your investment goals, and then evaluate their performance, expenses, and investment strategies. Evaluate performance and expenses. When evaluating a mutual fund, it's important to look at its historical performance and compare it to that of similar funds in the same category. You should also consider the fund's expenses, which can have a significant impact on your returns over time. Consider the fund's investment strategy. Finally, it's important to understand the fund's investment strategy, including the types of securities it invests in and the risk level of its portfolio. This information can help you determine whether the fund is a good fit for your investment goals. Make an informed decision about which mutual fund is best suited for your investment goals by following these steps. Keep in mind that investing in mutual funds is a long-term commitment, so it's important to choose a fund that you are comfortable with and that aligns with your investment objectives. Exploring other investment strategies beyond mutual funds. While investing in mutual funds can be a great way to diversify your portfolio and potentially achieve solid returns, there are other investment strategies that can also play a role in helping you reach your financial goals. By exploring alternative investment strategies, you can create a diversified investment portfolio that meets your specific needs and risk tolerance. Index funds. Index funds are a type of mutual fund that track a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq Composite. Index funds offer a low-cost way to invest in a broad range of stocks and can provide a level of diversification that is difficult to achieve on an individual basis. Exchange-traded funds, ETFs. ETFs are similar to index funds in that they track a specific market index, but they are traded on stock exchanges like individual stocks. ETFs offer a convenient and cost-effective way to invest in a variety of assets, including stocks, bonds, commodities, and real estate. Real estate investing. Real estate investing involves the purchase, ownership, and management of real estate properties, such as rental properties, commercial properties, or real estate investment trusts (REITs). Real estate investing can provide a source of passive income, as well as the potential for capital appreciation over time. Stocks. Investing in individual stocks can provide the potential for higher returns, but it also carries a higher level of risk compared to investing in mutual funds or index funds. When investing in individual stocks, it's important to do your research, understand the company's financials, and consider factors such as earnings growth, dividend yield, and valuation. Bonds. Bonds are debt securities that are issued by corporations, municipalities, and government entities. Bonds provide a source of income in the form of interest payments, and can also offer a degree of stability and predictability compared to stocks. By exploring alternative investment strategies, you can create a diversified investment portfolio that meets your specific investment goals, risk tolerance, and time horizon. It's important to remember that diversification does not guarantee a profit or protect against loss, but it can help reduce overall investment risk. Before investing in any alternative investment strategy, it's important to do your research and consult with a financial advisor to determine whether it's a good fit for your investment goals. The do's and don'ts of investing in mutual funds and other strategies. Investing in mutual funds and other investment strategies can be a great way to grow your wealth over time, but it's important to approach investing with a solid understanding of the do's and don'ts. By following these best practices and avoiding common mistakes, you can increase your chances of success and achieve your financial goals. DOS. Start early. Investing early and consistently over time can help you take advantage of the power of compound interest, which can significantly increase the growth of your investments. Diversify. Diversifying your investments across a variety of asset classes, such as stocks, bonds, and real estate, can help reduce your overall risk and provide a more stable investment portfolio. Do your research. Before investing in a mutual fund or other investment strategy, it's important to research and understand the investment's potential risks and returns, as well as its historical performance. Have a long-term view. Investing is a long-term strategy, and it's important to have a long-term view when making investment decisions. Don't panic during short-term market downturns, as they are a normal part of the market cycle. Don'ts. Don't try to time the market. Trying to time the market by jumping in and out of investments based on short-term market conditions is a common mistake that can lead to lower returns and increased risk. Don't put all your eggs in one basket. Concentrating all of your investments in one stock, mutual fund, or asset class can increase your risk and reduce the potential for diversification. Don't ignore fees. Investing in mutual funds and other investment strategies often comes with fees, such as management fees, expense ratios, and trading costs. Make sure to understand and factor in the fees when evaluating investment options. Don't make emotional decisions. Making investment decisions based on emotions, such as fear or greed, can lead to poor investment choices and suboptimal returns. It's important to have a long-term view and make decisions based on a well-researched investment plan. You can increase your chances of investment success and achieve your financial goals by following these do's and don'ts. Remember, investing is a long-term strategy, and it's important to approach it with patience and discipline. If you have any questions or concerns about your investments, it's always a good idea to consult with a financial advisor. Getting started with your investment plan. Steps to take now. Investing for retirement is an important step in securing your financial future, and with the right knowledge, it can be a straightforward process. Here are some key steps to help you create a retirement investment plan. Determine your financial goals. The first step in creating a retirement investment plan is to determine what you want to achieve with your money. This includes setting a retirement savings goal, considering your desired retirement lifestyle, and estimating the amount of income you will need in retirement. Establish an emergency fund. An emergency fund is an essential component of any investment plan, and it's especially important for retirement planning. This fund should be easily accessible and cover at least 6 months of living expenses in case of unexpected events or job loss. Assess your current financial situation. Before you can create an investment plan, you need to have a clear understanding of your current financial situation. This includes reviewing your income, expenses, debt, and assets. Consider your time horizon. The time horizon for your retirement investments is an important factor to consider, as it will affect the types of investments that are appropriate for your portfolio. Longer time horizons generally allow for a higher tolerance for risk, while shorter time horizons may require a more conservative investment strategy. Evaluate your risk tolerance. Your risk tolerance is an important factor to consider when creating your retirement investment plan. It's important to choose investments that align with your risk tolerance and comfort level, as this will help ensure that you are able to stick to your investment plan over the long term. Understand retirement portfolio allocation. Portfolio allocation is a key component of any investment plan, and it's especially important for retirement planning. The best way to maximize returns while minimizing risk is through diversification, which means having a mix of different investments such as stocks, bonds, and mutual funds in your portfolio. You can create a comprehensive retirement investment plan that will help you achieve your financial goals. Remember, investing is a long-term strategy, and it's important to approach it with patience and discipline. If you have any questions or concerns about your investment plan, it's always a good idea to consult with a financial advisor. Start investing in mutual funds now and reap the rewards later. Investing in mutual funds can be a powerful way to grow your wealth over time, as it provides a convenient way to access a diversified portfolio of stocks, bonds, and other securities. By investing in mutual funds, you can take advantage of the expertise of professional money managers, who can help you navigate the complex and ever-changing investment landscape. Additionally, investing in mutual funds can help you reap the rewards of long-term growth and compounding returns. By starting early and investing regularly, you can take advantage of the power of compound interest, which can help your investments grow significantly over time. However, investing in mutual funds is not a get-rich-quick scheme, and it's important to approach it with a long-term perspective. With the right investment strategy and a focus on building a well-diversified portfolio, you can help ensure that your money works for you and helps you achieve financial success in the future. Investing in mutual funds can be a great way to grow your wealth and meet your long-term financial goals, but it's important to start early, invest regularly, and approach it with a well-informed and patient mindset. With the right approach, you can make sure that your money is working hard for you and helping you achieve financial success in the future. Check out our other videos for more tips.